You know, we trust banks with our money, we interact with them pretty much every day, but how do they actually make their money? What's the real business model? Today, we're pulling back the curtain on the whole world of banking, and we're going to show you how knowing their game can help you win at yours.
Oh, we've all been there, right? You're scrolling through your transactions, everything looks fine, and then, bam, a charge you totally didn't expect. A maintenance fee, an overdraft fee, and it feels completely random, maybe even a little unfair. Well, that little line item is the starting point for our entire investigation today.
Okay, so what are we even talking about, officially? Well, bank fees are basically charges for services. Everything from the simple act of holding your account open to processing specific transactions. They can be one-time hits or recurring monthly costs. And trust me, as we're about to find out, they're a way bigger deal than you might think.
All right, so here's the game plan. We're going to start with that one annoying fee, then we'll zoom way out to understand the fundamental business of banking itself. We'll look at all the ways a bank makes money, then we'll zoom right back in to decode the most common fees, and we'll wrap it all up with a super practical action plan that you can start using like today.
All right, Section 1. Let's dive right into the thing that probably brought you here in the first place. That super frustrating, unexpected bank fee.
A $3 ATM fee here, a $12 monthly fee there. It feels like pocket change, doesn't it? But you know, when you start adding it all up over a year and then multiply that by millions of customers, it becomes a massive source of revenue for the bank. And here's the thing, you can't win a game if you don't know the rules. So our goal right now, super simple. Let's learn the rules.
Okay, to really get a handle on that little fee, we've got to zoom way out. We need to look at the engine of all modern finance, the real business of banking. And that means we've got to ask a basic question. How did this whole thing even start?
So the story actually starts centuries ago with, of all people, goldsmiths. See, people would drop off their gold with them for safekeeping, and in return, they'd get a little paper receipt. Pretty soon, everyone figured out it was way easier to just trade the paper receipts instead of lugging around heavy gold. And this is where it gets interesting. The goldsmiths noticed something brilliant. They saw that most people never came to get their actual gold, all at the same time. And that sparked this totally revolutionary idea. What if? What if they lent out some of that gold they were just storing and charged interest on it? And boom, that was the birth of the system that pretty much runs our world today.
And that system, it's called fractional reserve banking. And all it really means is that when you deposit your money, the bank is legally required to keep only a tiny fraction of it on hand, in reserve. The rest, they lend it out to other people and businesses.
Now, this is where things get a little wild. This system does something that might blow your mind. It actually creates new money. Let's walk through a super simple example. Say you deposit $1,000. The bank holds a small fraction, let's call it $100, in reserve. It then lends out the other $900 to someone else. But, and this is the magic trick, your account still says you have $1,000. So just like that, the economy went from having $1,000 to now having $1,900. That right there is the core of how banks expand the money supply.
And look, this isn't just some abstract economic theory. The act of making that loan literally creates a new deposit out of thin air. They're not just shuffling existing money around you guys. They are creating it. It's kind of mind-bending, I know, but it's absolutely fundamental to understanding how all of this works.
Okay, so if lending is their main gig, how do they actually make a profit from it? Well, it all comes down to a key metric called the net interest margin, or NIM for short. It's basically the difference, the spread, between the high interest rate the bank charges people on loans and the teeny tiny interest rate it pays you on your savings. That gap, that's the bank's bread and butter.
And this chart just illustrates that perfectly. Over here, you've got the higher interest rate they're charging on, say, mortgages and car loans. And way down here, you've got the tiny little interest rate they might be paying you on your savings account. That huge gap in the middle, that's the NIM. That's the profit engine right there.
So yeah, that interest spread is huge for sure, but it's not the whole story. Modern banks are way more complex. They've diversified, and they have a whole bunch of ways to bring in cash.
Think of a big bank's income like this three-piece pie. The biggest slice, yeah, that's usually the interest income we've been talking about. But look at these other two slices. You've got fee-based income, hey, there's our annoying fee, and then you have revenue from things like investment banking. The point is, fees aren't just some afterthought. They're a core piece of the business model. They provide this steady, predictable income stream, especially when lending profits get a little tight.
It's also good to know that there are really two different worlds of banking happening at the same time. Most of us, we live in the retail banking world. That's your checking account, your mortgage, your car loan,
But there's this whole other universe called wholesale and investment banking. This is the big leagues, dealing with huge corporations, governments, advising on billion-dollar mergers, totally different world, but it's often all happening under the same roof of one of those big bank names you know. Okay, now that we've got the big picture, let's zoom right back in. Let's connect all this high-level stuff to that statement in your hand. I mean, how does this giant money-making machine connect to that $12 charge? It's simple, really. That fee? It's the other side of their profit coin. So let's decode the ones you're going to see most often.
Here are the usual suspects. First up, the maintenance fee. Think of it like a monthly subscription for having the account. The overdraft fee hits you if you spend more than you have. The ATM fee is for the convenience of using another bank's machine. And then there's the NSF fee, or non-sufficient funds fee. That's the penalty you get if a payment bounces because you didn't have enough cash. They all have a reason, sure, but here's the good news, they are all potentially avoidable.
$1 billion. So what's this giant number all about? Well, after a lot of public pressure, a bunch of banks recently got rid of those NSF fees we just talked about. And the result? An estimated $1 billion a year in savings for regular people like you and me. That just goes to show you how massive the impact of these small fees really is when you look at the big picture.
Okay, this brings us to the final and honestly, the most important part of this whole thing. You understand the system now. So, how do you use that knowledge? Let's get into your action plan.
All right, think of this as your fee avoidance toolkit. First off, just make sure you have the right kind of account for how you use your money. Next, find out the minimum balance you need to keep and then keep it. This is often the #1 way to get monthly fees waived. Simple things like only using your bank's own ATMs can save you a lot. Definitely set up low balance alerts on your phone. It's your best defense against those killer overdraft fees. And hey, ask if setting up a direct deposit will get that monthly fee wiped out. A lot of banks do that. Go paperless. Seriously, some banks are actually starting to charge for paper statements now. And last but not least, just make it a habit. Review your statement every single month. Spotting things early is key.
And this is so important. By law, banks have to tell you about their fees. It's all there, I promise. It's just usually buried deep in the fine print of your account agreement. Look, it's your money. Take 10 minutes, grab a coffee, and just read that document. You'll probably be pretty surprised at what you can avoid just by knowing it's there.
So what's the big takeaway here? After all of this, what's the one thing to remember? It's actually really simple. Your bank operates on a set of rules, and those rules are designed to make them a profit. But the second you understand those rules, from the crazy big idea of creating money all the way down to that tiny fee on your statement, you're not a passive player anymore. You are in control. So there you have it. We started with one single annoying fee, and we went all the way to the creation of money itself. And now, that knowledge is yours. The next time you open your bank statement, you'll know the rules of the game. So the